And you're very welcome back to another Microcap Fund Manager interview. I'm delighted to say we are welcoming back Peter Johns from the Westferry Fund. Peter, how are you?
Yeah, well, thanks, Mark. Thanks for having me back.
Yeah, always good to have you with us. I said it might be an opportune time given reporting season has kind of just wrapped up in the last 2 and a bit weeks, to chat through a few stocks. But maybe before we jump into the stocks, actually a crazier time maybe after reporting season with everything that's happening in the Middle East in the first 2 weeks of March. But if we can get back to the last 2 weeks of February, all kind of thoughts on reporting season and kind of how kind of microcaps went overall. What was your kind of take on it?
Yeah, look, the sort of industrial microcaps that I'm focused on, we're fortunate in our portfolio that the vast majority either matched or outperformed what we were hoping to in terms of their updates. I think we had maybe one or two disappointments. Austin Engineering was a tiny position for us, which was a sort of a bafflingly bad result, and not just me saying that. The ASX gave them a please explain, and Fleetwood was a bit soft, but yeah, of the other sort of 25 plus stocks that we were holding, yeah, we were very pleased with how we went, and we had a pretty solid February in what was a crazy month really, where you had the large cap indexes up 4%, and yet the small ordinaries down 2%, and a massive amount of stocks in the sort of software, or what I call the quality at any price space, got an absolute hiding on the drop away in confidence from the potential effects of AI. So it was a crazy month, and we came through reasonably unscathed.
Yeah, I think I'd agree with that. Actually, a lot of the microcap results I saw were, all kind of like pretty decent if you take it at an overall level.
Yeah,
But yet the index was down. But then you look at the other side, there was a couple of real clangers, I would say, in the ASX 200 in terms of results. But it, as an index overall, finished up. So,
yeah.
it was it's hard to it's a hard old business, the stock picking game, as we know. And speaking of stock picking, we've got two stocks for us today. The first one we're going to chat about is Mitchell Services, ticker code MSV. And with results just haven't been out, maybe just give people kind of an overview of what Mitchell Services do and kind of thesis and how the kind of latest result tied into the overall thesis on it.
Yeah, sure. So Mitchell Services is a very unsexy company. It owns a whole heap of drill rigs, and it rents them out to usually very high quality tier one, tier two miners. Provides all of the staffing and the resourcing to actually carry out the drilling, and makes its money that way. And so uh, there's a lot of moving parts that sort of affect it in terms of some things it can't control, relating to weather or some mine closures here and there. But basically, it's a pretty simple business model. We have been invested in them on and off over the years, really, but it's built up a position from middle of last year. Partly because the stocks, well, the price had been in the doldrums for a while. They'd had a couple of poor years, which result of some overhang in a dispute they had with a client some years back. Then they were making some good progress. And then in FY24 and some into FY25, they had a big build up of work basically, which required them to spend a lot of money getting drills ready, deploying some, and setting up a new business in PNG. And that sort of hid what appeared to be an underlying good momentum. And our thesis was that that underlying momentum, now that those drill rigs in those new mines in PNG and elsewhere were set up, would start to show through. And that was coupled with late last year, we had sort of amazingly good weather here in Queensland, which is where a lot of the drills are deployed. So uh, that was the initial thesis. Um, the results subsequently to that, particularly this half year result, well, the quarterly result and then the half year result have kept us in the stock and indeed seen us increase our stake, notwithstanding that sort of initial weather thesis, short-term weather thesis, now is rather secondary to us. We feel that it's a really well-managed company that has good capital management. They have a large 20% shareholder, Nathan Mitchell, who seems to have a very sensible approach to capital management, and they just paid a 4-cent fully franked dividend. And so we feel that, notwithstanding short-term things, that they've actually sort of traded into a good micro and macro environment. Micro because it's well run at a firm level. Macro because um, gold is and the price of gold has been sufficiently high that it's now resulting in a lot of interest in the East Coast, as well as obviously the West Coast is already a very intense part of the gold mining world, but the East Coast is ramping up there, and that will help to increase the utilization of their drill rigs.
I mean, as we know, the exploration space hasn't seen a lot of capital from the big miners for many many years, and that's across a lot of commodities. Gold, copper. The big miners have been very reluctant to. It's been a lot of, I think, from the kind of even from the 2015s, it's nearly 10 years. Where they've been very reluctant to sink money into new projects. M&A by and large has been down a lot compared to what it was in maybe the 2010 to 2015 period, or even before that, maybe 2005 to 2015. So would it be fair to say Mitchell Services, if you get an uptick in exploration more broadly, whether we're talking copper, we're talking gold, nickel, any of those kind of any of those kind of metals, and they're going to be a beneficiary of it. And if we see on a kind of an industry scale a kind of return to, actually we need to start doing some exploration. We can't put on the long finger any longer. That they're going to be a bit in the sweet spot for it.
Yeah, that's central to our thesis. And look, even if that didn't happen, we think they're currently cheap enough, even if they don't allocate any more drills. So they've got about nearly 90 drills. Last year they have about 65 of those operating. So they've got more to deploy, and there's real operational leverage there, right? So each new drill, the profit on that drill drops um, to the bottom line. So absolutely exploration and production. I mean, most of their drills are allocated to production, but exploration either soaks up other supply or is something that they can directly allocate to. Um, Look, my discussions with management as recently as today, I had a conference with them, is to the effect that they've now got the sort of very good position whereby they can say no to customers that are perhaps less credit worthy or they don't like to work with. They've got a good stream of really high quality miners approaching them, and that does extend to areas, particularly in gold and silver, where the price has been sufficiently elevated for now many months, that it's got to the stage where some of the big miners have gone through their reasonably bureaucratic approval phases, and we're starting to see either exploration, as you say, or ramp up in production. So that will help. The other sort of big area that they focus on, and then they are an East Coast. They are the biggest East Coast driller. Okay, so you've got a couple of big players in the West Coast, and then they have a couple of rigs in the West Coast, but they're predominantly East Coast, predominantly Queensland. And coal, metallurgical coal is a focus that has been soft for them for a couple of years. So, and it's only recently that gold has become actually the main mineral that they're working with. But things are looking a bit up for coal. Obviously, the current situation with Iran may be short-lived, but it is increasing thermal coal predominantly prices, but metallurgical coal is also has certainly uh, short up in terms of its price. There's also in Queensland the benefits perhaps that might come from. There's a couple of mine closures last year that came about through fires and accidents. The indications are that they will reopen in the next 6 to 18 months, and that will also create a or put a floor under the sort of coal drilling demand. Just on that, I should throw in the sort of last part of the thesis, and we see this as a complete bonus. They have a um, a business that they're a large investor in called Loop. Loop is a sort of a startup, as it were, that is in the process of being proven up, whereby they use very specialist drills to tap coal seams and this is for mining, not nothing to do with coal seam gas, but it helps to extract gas in a way that is environmentally friendly and is beneficial to the miners because at the moment they pay very large, um, not penalties, but they pay very large amounts under regulatory rules relating to the release of gas during the mining process. So this very much, this is sort of the thesis sounds a bit pie in the sky. That's the type of startup I'd never invest in directly. But they did manage to sell a large chunk of the company to Sumitomo, massive Japanese conglomerate who have invested money in it. And the good part about that is it essentially provides the capital for that entity, um, which Mitchell still owns a good chunk of to get to the proven stage. They've had a successful trial, and I know they've got another successful trial starting very shortly with a mega tier one entity. And that's sort of a real bonus potential going forward. Even if it's not, Mitchell benefits because during these testing phases and whatnot, they're supplying the crews and being paid for the drilling. So that's sort of an added lottery ticket, I suppose, with this stock.
Kind of post results and when you were catching up with them, maybe today or earlier. Would you say they are at the point in the cycle where they can also start raising prices now, or are we a bit too early in this cycle where it's just more their book is filling up and they're getting we're still only kind of filling up the volume. We aren't guys. Everybody needs rigs. Whoever's paying the highest prices will send rigs your way. We're not at that point in the cycle.
Yeah. I was speaking with management. They recall fondly days when that was the case, when
Mm.
basically miners would pay anything to get a rig out the door and set up. They've made it clear that they're not quite there. They feel that things are way better than they were a year or 6 months ago. Um, Pricing's fair. Labor's hard to get, but they and that's probably one of the biggest difficulties for them. But related to this, they say that the bigger miners certainly understand that they're dealing with the same issues themselves and are being very fair with pricing for a good professional outfit, and that's really their advantage, that there's not many people with their scale who can put crew on the ground, who can guarantee crew a career and good work over many times. They've been around 50 years. Um, the replacement cost of their equipment is massively above the current value. It's got a book value of around 60 million. It probably has a scrap value or a sale value of 120 to 130 million, but the replacement value to set up another entity like that with all of the regulatory aspects around it these days would be very hard. So there is a real moat, even though it's a very sort of old school, boring business. And just quickly before we move on, the numbers around the stock that made $8 million NPAT last half. I always like there to be a few little Easter eggs or bonuses when I'm looking at stock, and this has a couple of them. So in the first half, that 8 million NPAT, and this is for a stock that has 100 million market cap with zero debt even after it paid zero debt after it paid the dividend out. 8 million NPAT and the franking credits from after payment of taxes being paid out to shareholders. They that was despite, I think, well over $1 million was costed from a fire of a rig. which they will get back in insurance, and that $1 million will come back just because of the way accounting works as revenue in the second half and go straight to profit. Um, and and this comes up with both companies I'm talking about today. They're very conservative with depreciation and amortization, so they depreciate well over $20 million a year against their equipment. Um, that tends to be higher than the maintenance capex for capex up and down, but they're not really having to buy new rigs, and they don't intend to be. So there's I reckon $2 to $3 million a year at least where cash flow is actually better than even the headline NPAT figure.
Yeah. Um, yeah, definitely want to keep an eye on if gold prices and broader commodity prices, tend to are going to hold up through the rest of 2026. Second one, I want to move on. A business
Yes.
that's been listed for long, long, long time, always been the junior player to Webjet and Flight Center and a few other in that space. Helloworld, the travel agent, not one I think we've ever covered on any of these interviews. So this will be this is we're breaking new ground here.
Yes, and I'm not making life easy for myself picking this stock and pitching it into the current environment. But maybe that's where the opportunity is. You're right; it's always been the poor cousin, junior partner. It's sort of had a checkered history, but it has slowly improved. It's really nicely profitable. A lot, it has traditionally had a bit of a messy sort of balance sheet. It's rolled up a lot of different companies. It owns bits and pieces of other things. But I think there's a narrative sort of emerging now. Look, in the short term, that's taking an unknown hit from events in the Middle East. And there's I'll come to it shortly. Their first half profit was matched with a full year outlook. It'd be no surprise now to the market to hear that full year outlook pulled. They haven't pulled it yet, but in my view, it's very much cheap enough, even if there's a substantial downgrade. And we've seen during COVID that ultimately with these stocks, the market is, after an initial panic, prepared to dive back into them when things continue or the short term effects, wash out. Um, and just on the big picture environment with this stock, the other headwind with these is AI, and that puts a dampener on some of these stocks. If you want to get into this stock, you probably have to share my view, which is not perhaps widely held, that there's certain types of things that are always going to be have a human element, and one of those is, and some will know that I'm a director in a law firm. I think people massively underestimate the degree to which people want to deal with other humans or have their hand held when dealing with big transactions, whether it would be, in legal sort of situation, whether it be choosing insurance with an insurance broker or, buying a house, real estate agents we've seen in the past, do it yourself type real estate agent entities, which never really worked out, despite the fact they're massively cheaper. Um, in travel, I think people underestimate that in significant travel, especially the older people get, they want a hands-on touch, and AI will never be a trustworthy partner, a full partner. Perhaps it'll take some parts and may even add to the efficiency the likes of Helloworld can gain, but it will never be a full partner. And so that the runway of these stocks or these companies is long in my view, and I'm happy to take whatever short-term hit there is from the Iran situation.
Yeah, I think I would kind of agree with that. I think for booking something that's straightforward, you're going to a hotel for like 3 nights or something. Fine, you're flying from where you are up in Brisbane, so Sydney to Brisbane straight flight. You can like do that yourself. But I think these multi-city where you're flying on different airlines and maybe going to Europe, but you're flying out of into London, but like back out of Rome on a different airline back to Australia with like internal flights. And when I think you up the complexity, I think that's where people go to travel agents. One, to try and get the best price because you're trying to search all these things yourself. But
Yeah.
two is, okay, have I considered everything? Am I like covering all my bases here? Because this is probably a very expensive trip if you're going from Oz to Europe. So you definitely don't want to be incurring any extra expense on top of an already probably large holiday or even work budget if it's a work trip.
Exactly. And even booking tours, booking a cruise, anyone can book a cruise online, but getting the right room, booking the right uh, tours, and that kind of thing. And the big thing is making sure it's all right. It's just why you go to a lawyer. Well, some legal work you might be able to do yourself, but you're paying someone to blame. And when you're holidaying in a multi sort of entity, whether it be cruising, flying, hotels, tours, you're paying for someone to call if something goes wrong, and so that you don't have yourself or your spouse to blame. And I think there's a lot of uh, sort of utility in that model.
I'd never blame my wife. People, I don't know about you. You should know anything on. But if we take Hello World, so let's what's happening with oil prices and jet fuel prices and the impacts that has on kind of the broader travel space from hotels to international domestic tourism and flights, all that. The if we take a look at Hello World's business as we move through 26, 27, based on this like half year result that's just come out now, like what are you looking for to kind of come over the subsequent results now, when we get to August and February, March next year, what are you kind of looking for to kind of keep you in the stock and for the thesis to kind of play out from where we sit today?
Yeah, well, I'm prepared to excuse some aspects of it from the macro point of view, but largely, leaving that aside, seeing that if they can increase their profit off the back of some reasonably solid investments they've made, sort of bolt-on small investments. One of the biggest being they already own half of a um, company which is a mobile travel agent, and they bought the other half of that, which they paid 30 about $35 for that. That makes some of the accounting a bit messy, but does mean the second half of this year and into next year, you'd expect to see that flow through. So um, the in terms of some of the numbers, it's and I think part of this is again, I look for stocks like this where it's a bit hard for the average punter to analyze. There's a lot of moving parts when you look at the finances of this company because they've had some gains on sale. They own shares in Webjet, WJL, which hasn't gone all that well for them recently. So you get the sort of the share price revaluations of that flowing through the P&L. So you have to work pretty hard to get an underlying feel and even their own underlying numbers, I think probably add back some stuff that I personally wouldn't. So, looking at it on my underlying numbers, on what I saw in the first half was, I think, an EBITDA of around 29 million. And, they again, like the last topic we discussed, they are pretty conservative, not by choice, but the DNA of around 7 million, is higher than what their actual capex is. Part of that is because it's, I expect some of it's the amortization of intangibles and then, amortizing previous periods of higher capex. So there's a bit of a bonus there, but it's about 7 million. About this is on a half year basis, and about I think 1 million in rent in interest going forward. Gets you to um, I think an underlying profit before tax in the first half around 22 million. They're guiding to a what on my numbers would be an EBITDA of um, probably around 24. Um, so we're just talking to you around 24 million profit before tax in the second half. And so, it's getting you to a, well over 44 or so profit before tax on a 4 year basis. And the market cap's 240 million at the moment. Um, Obviously, the market's expecting, two things. Why is it so cheap? Two things which we've discussed that, there's the short-term headwinds from Iran and oil prices, and there's a longer-term threat from AI. And I'll explain my view on those. There's the interest rates as well. Interest rates, and literally while we've been speaking, that the RBA has raised in the last few minutes. Yes, that obviously affects discretionary spending of some part of the market, but a big part of their market is older people booking cruises, booking tours, and the people that tend to benefit through term deposits, etc., from a higher interest rate. So it's not a clear cut negative at all for the likes of Helloworld, in my view. So yeah, I'm looking to see that they can, if we can, I'll forgive them a short-term downgrade, but yeah, through to FY27, at least maintaining that sort of level of profitability, maintaining their strong balance sheet. And is strong. You have to be careful on its face. It looks like they've got a big chunk of net cash there. A lot of that's because it's a sort of negative working capital business, which is attractive. If you look closely at the payables, there's a huge payables number there, but with the cash receivables and their shares in Webjet compares very favorably to the debt and payables. So it's a nice solid balance sheet. They've got room for further acquisitions if they come up, and they are becoming a more sizable player. And hopefully they can benefit a little bit from the travails of corporate travel, and we all know the problems that they've had. Corporate travel is not a massive part of their business. They do a lot of retail and sort of wholesaling of tours and whatnot and experiences. But they mentioned in their last report that they've signed up all the corporate travel work of Collingwood Football Club and staff, and then obviously that then extends to the supporter base too. But there may be some upside there from them. So the price is such that I don't need growth. I want to see at least the sustainability and friendly capital management, which they're doing at the moment. The dividends are good. I would say the biggest danger is if they do something stupid, and then that probably is the biggest concern for me. They did make a takeover offer for Webjet some months ago at a price that I think, well, I mean, that subsequently turned out that Webjet had a pretty solid downgrade and wouldn't have been a great price, and sensibly they seem to have backed off. Um, but I'd have to be convinced that throwing a massive amount of money at Webjet would be a good idea. Um, I think it's a case of incrementally growing rather than making a huge sort of whack at something.
Yeah, or a few. If they're, if they want to grow and they see acquisitions as part of the growth strategy, maybe keep it to the bolt-on kind rather than, trying to take out a large competitor of theirs in one fell swoop.
Yes.
Yeah. Peter, thank you. We'll leave it there. Two interesting names and from vastly different industries, but profitable, dividend paying. That puts them in the minority in the microcap space. In the quality microcap space, anyway. If you can get down to paying a dividend, I think I've looked at this in the past. Less than 10% of stocks, which we would class as microcap, under 300 million actually pay a dividend. So you're looking for a
Yeah.
quality marker, you'll find only a small subset that actually make it to the dividend piece. So thank you, and yeah, we'll hopefully have you back on maybe September. We can do a wrap up after the full year results.
Yeah, brilliant. Thanks very much, Mark.